Let's dive right into one of the most absolutely fascinating companies in the entire transportation sector today. We're talking about Aurora Innovation, trading under the ticker symbol AURA. Now, the goal of this explainer is to unpack a massive, almost mind-boggling valuation that, frankly, has a whole lot of people scratching their heads. I mean, $14 billion for a company with almost zero revenue? Okay, let's dive into this. Because to truly grasp what's going on with Aurora, we have to reconcile this incredible, groundbreaking tech platform with some seriously early-stage financials. It's a wild ride, so let's get into it. Real quick, here is exactly how we're going to map out Aurora's story today. We'll start by looking at that $14 billion paradox, and then we're going to decode their two-phase business model. After that, we'll use a really simple analogy to make their whole strategy crystal clear, project out three potential futures for the year 2030, face the harsh reality of their current cash burn, and then we'll wrap it all up with some final takeaways and our standard disclaimer. Section 1. The $14 billion paradox. Right, so there is this massive, glaring contradiction at the heart of Aurora's current stock price. And honestly, it makes this an absolutely incredible case study in how markets value future technology. $14.15 billion. That is Aurora's staggering market capitalization as of their latest filings. The stock is trading right around $7 to $8 per share, and there are roughly 2 billion shares outstanding. Now, you might be thinking, in the traditional trucking and logistics world, a $14 billion valuation usually means you're looking at a mature, cash-flowing behemoth, right? Well, Aurora is definitely not your traditional company. Because when you compare it to that $14 billion valuation, here is where you get absolute financial whiplash. $2 million. That's it. That was their entire recorded revenue for Q2 of 2026. Now, sure, that is technically a 100% year-over-year increase from Q2 2025, but come on, it's a microscopic fraction of their market cap. And to add to that, their full-year guidance for 2026 is heavily backloaded at only $14 to $16 million total. So the obvious question is, how on earth does a company bringing in just $2 million in a single quarter command a $14 billion price tag? Well, the answer lies in this concept right here. It's called the total addressable market, or TAM option. Essentially, the market is completely ignoring current fundamentals. Instead, they're treating Aurora as a technology platform option for the future. You see, they're targeting the North American long-haul freight market. We are talking about an $800 billion industry where even a tiny fractional sliver of market share translates into massive, massive profits. To justify this ticket to the future, Aurora is leveraging a seriously impressive operational run rate. They've already logged over 440,000 driverless miles across 10 commercial routes down in the Sunbelt. So investors are essentially paying up today for a golden ticket to a future where Aurora's tech completely dominates those highways. Section 2. The two-phase business model. Now, what's really interesting about this slide is how it breaks down Aurora's evolution. It's built around a very distinct two-phase strategy. Phase 1 is transportation as a service, or TaaS. This is exactly where they are right now in 2025 and 2026. Think of this as the necessary but honestly very painful bridge phase. It is incredibly asset-heavy. Aurora actually has to physically own or lease the trucks, outfit them with all their own LiDAR, cameras, and computing hardware, and physically run freight for clients like FedEx and Uber Freight. It proves to the world that their system is actually safe, but man, it burns a literal mountain of cash to operate. But then we look at Phase 2. This is Driver as a Service, or DaaS. This is the holy grail, the ultimate goal starting in 2027. In this phase, the model shifts to being asset-light. It becomes purely focused on recurring software fees, which drastically slashes their capital expenditures and unlocks these massive software-like gross margins of 60% or more. Let's break down how this actually looks in the real world once they hit that Phase 2 DaaS model. Step 1. The truck manufacturers, the big OEMs like Volvo and PACCAR, they build autonomous-ready trucks directly on their standard factory assembly lines. This completely bypasses the need for Aurora to do those expensive aftermarket retrofits. Step 2, the freight carriers, companies like Schneider or Werner, they go out and buy those specialized trucks directly from the OEMs. And then finally, Step 3, Aurora steps in. They license their virtual driver software and remote assist infrastructure to those carriers for a recurring fee, which is typically around 35 to 50 cents per mile. And why is this a total no-brainer for the carriers? Well, a traditional human driver costs anywhere from 80 cents to $1 per mile. And that's not even counting benefits, mandatory rest stops, and incredibly high turnover rates. Aurora software can literally drive the truck 24 hours a day without breaks for roughly half the cost. It's an absolute game changer. Section 3. The college tutor analogy. Okay. To make this shift from heavy logistics to scalable software really intuitive, think of this as building the autonomous iPhone and App Store. It's a guiding concept that perfectly bridges the gap between traditional hardware and scalable software licensing. Let's try a quick analogy. Imagine you invent a revolutionary piece of software that turns any laptop into a 24/7 automated private tutor for college students. In phase 1, computer manufacturers don't know you, and they definitely don't trust you yet. So you have to go out and buy 100 laptops out of your own pocket, painstakingly install your custom cameras on every single one, and then rent them directly to the students for, say, $10 an hour. Now, sure, you're making some revenue, but buying and fixing all those physical laptops, it completely eats all your cash. It's exhausting, and it's incredibly expensive. But then, you hit phase 2. You've proven the tech works flawlessly. Now giants like Apple and Dell agree to just pre-install your sensors right on their factory lines. The students go to Best Buy, purchase a laptop themselves, and simply pay you a $2 an hour software subscription. Suddenly, you aren't paying to build, store, or repair any hardware. You just sit back and collect those high-margin licensing checks. And you know what? That is the exact transition Aurora is desperately trying to execute, just with 80,000-pound 18-wheelers instead of laptops. Section 4. 3 Futures for 2030. Okay, keeping that business model in mind, let's look at 3 very distinct paths for where this company could be by 2030. First up, the bear case. Here, execution bottlenecks and friction with those OEMs drastically limit the fleet to under 2,500 active trucks. That caps their annualized revenue at around $350 million, keeps gross margins completely stuck below 25%, and it forces massive, painful share dilution just to keep the lights on for another few years. But look over at the base case. Aurora achieves steady expansion across the Sunbelt, successfully hitting a fleet of 6,000 to 8,000 trucks and $1.2 billion in revenue. In this scenario, they effectively reach positive cash flow by 2028 or 2029. And then, oh man, there's the bull case. If they successfully scale this thing nationwide via fully integrated OEM production without a single hitch, we could be looking at a massive fleet of over 15,000 active trucks. That translates to an unbelievable $3 billion in high-margin, recurring software revenue. And this brilliantly illustrates how those fleet projections create a staggering variance in potential outcomes for investors. Looking at the chart, the implied market cap in the bear scenario drops down to an average of just $4 billion. That would be a massive haircut from today's valuation and would severely punish early believers. The base case? That suggests a modest bump to around $17.5 billion, which honestly represents relatively flat per-share returns once you factor in all the dilution they'll need just to get there. But that bull case? A $42.5 billion market cap target. That represents massive upside, driven entirely by commercial scaling and completely overcoming those factory OEM bottlenecks we talked about. Section 5. The cash burn reality. But hold on, because before Aurora can even dream of those 2030 projections, they have to survive the present. And this number right here, this is the immediate threat to their entire operation. Negative $270 million. That was their net loss just in Q2 of 2026 alone. Let that sink in. Aurora is spending roughly $700 to $800 million every single year just to keep the operations running. The vast majority of this cash, over $200 million in a single quarter, goes straight into heavy R&D, constant iterations of their sensor hardware, and physically maintaining that early bridge fleet out there on the roads. So, the crucial point is how they manage this relentless cash burn. That's the ultimate deciding factor. Right now, they sit on about $1.22 billion in total liquidity. That gives them a runway of maybe 5 to 6 quarters before the well completely runs dry, assuming they don't do any further capital raises. To survive, they rely heavily on what we call a dilution bridge. Specifically, they use an active at-the-market or ATM equity facility. They actually raised $215 million exactly this way in Q2 alone, just by selling new stock directly into the market. So the ultimate risk for anyone watching this is whether management can survive this incredibly heavy burn phase by issuing new shares without completely destroying the per-share value for the investors who are holding the bag today. Section 6. Final takeaways and disclaimer. All right, as we wrap this up, if there are 3 things you take away from this explainer, let it be these. First, the software itself, it's no longer the sole bottleneck. The true hurdle to their success right now is OEM assembly line maturity. Aurora desperately needs manufacturing giants like Volvo and PACCAR turning out fully redundant, factory-built chassis at a massive scale. They're currently partnering with Roush to target a 1,000 truck per year run rate, but mass manufacturing hardware is notoriously difficult. Second, Unlocking that Phase 2 driver as a service model is absolutely required. There is no way around it. They simply cannot reach those promised 60% plus margins while they still physically own and operate the trucks. And third, remember, we have only scratched the surface of this incredibly complex topic today. So please, definitely use all the other links provided in the description to gather more information and review the extensive source filings for yourself. It is super important to do your own homework here. And as always, before making any decisions, please note, this discussion is for informational purposes only and does not constitute financial advice. Please do your own due diligence before investing. So I'll leave you with this final provocative thought. The underlying technology is undeniably mesmerizing, and the total addressable market is absolutely gigantic. But can Aurora survive the brutal cash-burning bridge phase long enough to finally become the dominant operating system of the highways? It's a billion-dollar question. Let us know what you think and keep on learning.